Hello, I'm Christopher Tate. In this short presentation, I want to look at the notion of simple trading systems. But more importantly, I want to look at simple trading systems in light of this need for complexity that traders have, this desire to make trading much harder than it really is. And the intriguing thing about this is that even those in the financial media, even those in the retail side of trading, that is those who sell you products like stockbrokers or financial planners, would have you believe that trading is this enormously complex endeavour that no one other than them could ever possibly master. In this presentation, I want to put that little myth to bed, and I want to look at a few key components of trading systems, and I want to dispel as much as possible this notion of complexity being the be-all and end-all of trading systems. But before we begin, a little bit of housekeeping. As always with these sort of things, you have to give a disclaimer. And so any information you see here presented today is simply educational in nature. There is no advice given directly, nor is there any advice implied. So in terms of what I'm going to talk about, I want to explore the attractiveness of complexity. Humans by and large like complex things. The smartphone or PDA has now displaced the diary. Granted, your smartphone can do more, but you can't drop it in a puddle and recover it. You can with a simple diary. We're drawn to this notion of complexity. We like things that are complex. And there are reasons for that desire, that attraction to complexity that I'll talk about in a moment. I want to look at the relationship between complexity and success, if any. And I will give part of the presentation away right now. I don't think there is any nexus between the two. And in actual fact, I think quite the reverse. The more complex a system becomes, the more prone to breakdown it becomes, and the harder it becomes for the user to actually enact the system correctly. And finally, I want to examine some very simple trading systems and some very simple trading philosophies. And these are the philosophies that actually guide the mentor program. And we always keep these in the back of our mind as we walk through the process of trading system design. So they're very much at the cornerstone of our thinking. They guide virtually everything we do. And the aim in all of them is to be as simple as possible and to be as efficient and as effective as possible. I'm going to recommend a book to you. The book is called Sync by Stephen Strogatz. Strogatz is a mathematician who looks at the phenomenon of natural systems to fall into sync together, the notion of birds flocking or fish schooling. The interesting thing about that is they appear to be very complex behaviours. But the flocking of birds can be modelled with two simple rules. And the rules are this: keep up and don't bang into the bird next to you. And out of those simple rules you get enormously complex behaviours. Markets are a little bit the same way. You get what appear to be very complex behaviours out of very simple initial conditions. And Strogatz wrote this book largely in response to the notion that what he saw was that an attempt to explain natural phenomena was heading down the path of complexity and assuming that everything was complex and that nothing could be explained without reference to complexity. Whereas what I've said he found was that very complex systems can be explained by very simple rules. And it is this philosophy that I want you to keep in the back of your mind when you look at this presentation and when you think about trading system design. It is very possible to get very complex outcomes from very simple systems, and you can apply very simple systems in a very reductionist manner to what appear to be somewhat intractable problems. we are drawn to complexity because of the nature of the information we receive as traders. Trading by and large is an information management profession. Many people think it's about reading company reports, looking at charts, consulting the phases of the moon, any manner of strange things. When in actual fact, all we're attempting to do is manage the information that we receive. And we can see how this would be a problem for us. We can see how this would lead us to complexity. This is just a screen grab that I took from an online dealing system. And these are overnight quotes for the Australian dollar futures contract. And you can see in the centre of the screen, we have the bog standard quote screen. We have open, high, low, close, we have the time it was done, we have the settlement price, we have the change from the previous session, all the information you would expect. And it's presented in this raw form. To the left we have the possibility to look at other instruments. Below our quotes we have various news items that might be relevant to what we're looking at. And finally down the bottom we have inducements to go and visit other sites, other instruments, other bits and pieces. So the information we receive has this look of complexity to it. And this drags us naturally to thinking that to understand this information, we too must be complex. Which leads to the question of how do traders make decisions? And this is a very, very fertile area for study. Traditionally it was thought that traders made decisions in the manner of the efficient market hypothesis. The efficient market hypothesis, which is a cornerstone of modern finance and is one of the bedrocks of modern portfolio theory, in a nutshell states that investors are rational and that they will act in a rational manner to maximize the financial utility of any information they receive. So by and large, it assumes that traders are perfectly rational individuals, that we respond rationally to all market events, and that any information we receive is not filtered in any way. It's frictionless in the way we take it in, so that it goes through no perceptual filter, we don't alter it in any way, we have no biases whatsoever. We are simple automatons, so that when we receive information, we simply insert part A into slot B, and we do that irrespective of market conditions, irrespective of the way we feel, irrespective of our history, irrespective of our culture. So that when we see information like this, we can instantly make rational decisions about what is occurring. The fact that there is a sea of red against the quotes will not have any emotional impact upon us because we're completely rational. We don't act emotively, and we would understand that these events were perhaps occurring within the context of our long-term investments. So they don't actually mean anything to us. So the Dow being down 138 points, as per these quotes, would be irrelevant to us. We'd have no reaction to that whatsoever. We would continue to act rationally and logically. The reality is somewhat different. The reality is humans are irrational, and traders in particular probably have the same degree of rationality as a 15-year-old girl who's just had her Facebook access removed. We are not automatons. We do not act rationally. If you look at the precepts of game theory says that when we make decisions, our decision-making capacity is bounded. It's bounded by the time we have to make the decision, the information that we receive and the quality of it, and our cognitive ability. So all our decisions under the auspices of game theory are limited in their effectiveness. I would say yes, that's quite true for playing a game. However, in trading, I would suggest that our capacity to make irrational decisions is unbounded. And irrational decisions are everywhere in markets. You see people selling stocks that are going up. They buy stocks that are going down. They consult astrological charts as if this will somehow help them make a decision. So the efficient market hypothesis falls down because its central tenet that we are rational is incorrect. And so if the central tenet of a philosophy is wrong, then by and large the philosophy itself is found wanting. So my thoughts on why we seek complexity, why we go down this path, are really quite simple. When we're presented with this information, and this is a chart of the S&P 500, we know what has happened, we don't know what will happen, but we desperately want to know what will happen, and we want to know in advance. And whilst humans are quite good at looking at patterns and looking at structure, we still want to know what tomorrow's pattern will be. But that's continually denied to us. We're stuck with yesterday's information. And the problem is when we're presented with this information, we're not given any rules as to what to do with it. In trading, there are no rules that apply to you. There are certainly rules that exchanges have regarding settlement and their procedures, but you can buy and sell in any manner you see fit. You can use any decision-making process you want, but it has to be your decision-making process and you have to make it up. And herein lies the issue. It's your decision. And this is problematic for people. And it's problematic because for the first time in most people's lives, they're being forced to make decisions for themselves. Most people are employed. Most people operate under the constraints of their employer. They know what their job description is, what the rules pertaining to their job are. They know when to be there, when to go home. Trading's not like that. In trading, all the rules you generate are your own, and they're completely yours. You may want to try and copy somebody else's, but this is somewhat like trying to walk around in somebody else's shoes. To give you an insight into this, consider the notion of lotteries. Lotteries are very, very well studied in terms of both their psychology and also their statistics, because there's reams of data. There is an interesting observation of people who play lotteries. When you watch people fill in a lottery ticket or coupon, you will notice that they pick numbers, and they pick numbers that are relevant or special to them, that may have meaning to them. Numbers such as anniversaries, children's birthdays and the like. But consider this. If I'm playing Powerball, my odds of winning are 1 in 58 million. Those odds never change, whether the machine picks the numbers for me or whether I pick them. When profiled, the people who pick numbers believe that in picking the number they are exerting some form of control over an unknown outcome. That in some way the mere act of picking numbers changes the statistics in their favour, and that somehow the lottery gods will be aware of the numbers they've picked. The same is true for traders. We seek to impose order on an environment where there are really no native rules for us. And markets are completely unknown to us. The future is opaque. We can't actually see it. Despite what some lunatics will attest to and believe, we can't. So what we do is we apply rules, tools, indicators, and we believe that the more of these we apply, the greater is our perception of control, and the greater is our rational control. Much in the same way as people who pick lottery numbers pick them thinking they will exert control over the event. So if we remove this notion of attempting to control events, attempting to see into the future that is forbidden to us, we have to ask the question of how well do simple systems do? How well do they perform when compared to more complex systems? To answer this question, what I've done is I've taken a very, very simple concept and I've compared it to a commercially available system called Oddball. Now, my simple system is long only, it trades on weekly data, and it makes its decision on a Monday morning. Oddball is a daily system, which goes long and short. It has its own unique exits. And I tested this system over the XJO, the ASX 200, or over the XJO futures contract. And we generate some interesting statistics. We start with the same amount of capital. My simple system, with only 2 rules, finishes with 240,000. Oddball finishes with 185,000. The interesting thing is that Oddball has a larger number of winning trades than I do. I only win on 27% of the time. It wins on 40% of the time. But my largest win is nearly twice its largest win. And my drawdown is half its largest drawdown. So we start to get a sense that very simple things can perform very, very well. And the interesting thing is many of the systems I use that perform very well actually only have 2 lines of code. They effectively only have 2 sentences to describe them. Yet they perform very, very well. And this is an indication of that sort of system. And if we break these returns down by a year, you can see the measure of outperformance. And the issue here is a simple one. We're looking for very, very large outsized gains, and that's what this system is designed to do. But it can only capture those by looking at simple concepts such as long-term trends, by effectively stepping back from what is happening in the market and then making a decision. One of the problems with the management of information is that people believe that the more information they have, the better their decision making will be, the better the fidelity of their decision making. Unfortunately, if you look at the notion of decision making as a science, this is not true. And in every aspect of human endeavour, from medicine to flight engineering, there is an attempt to make decision making much simpler, to remove inputs so that we're not overwhelmed by information. There is that long-held sort of belief that humans can only take in 7 pieces of information plus or minus 3. I would even think that that is being optimistic. Our capacity to absorb information, particularly under stress, is very, very limited. So something that is very, very simple solves that problem. It's also important to note that activity in no way equals profitability. Many complex systems are built upon the notion that you need to be active all the time, that you need to be constantly doing something. This is not true, because it is actually the sitting in a position that makes you wealthy, not the leaping in and out that makes you wealthy. Now, activity feeds your ego, and it makes you feel as if you're part of the action, but that may not be conducive to your overall profitability. And in actual fact, if you look at the literature regarding trading, regarding investing, more active accounts have a lower rate of return than less active accounts. Churn does not work as an investment strategy. It works for brokers in terms of the amount of commission they generate from your account, but it doesn't actually work very well for you. But within this is also this overriding philosophy. The perfect systems do not exist. There is no such thing as a perfect system. There will be instances whereby your system gets you in at the wrong time, it gets you out at the wrong time. This just simply happens. As a case in point of how this can stymie people, I mentored someone probably more than a decade ago who is obsessed with the notion of the perfect system. And in the 10 years since I mentored them, they have not placed a trade. and they've not placed a trade because they cannot come to grips with the notion that they will never be 100% successful, that this system will have periods where, like all businesses, it loses money. So you need to get over this hump within your system, and simple systems require this of you, that you accept that, like my very simple system, your rate of winning is quite low. So if your ego is tied to that, then you will have problems. The other issue we need to look at very, very briefly, and I'll only touch upon this in a simple manner, is the drive towards magical thinking. Traders are very, very superstitious. They are desperate for some tool, instrument, idea that will enable them to predict the future. So we have rubbish like Gann, Elliott Wave, we have astrology, none of which have been proved to be of any use to traders whatsoever. But much like lottery winners picking lottery numbers based upon birthdays, traders are drawn to this sort of thinking, and this sort of thinking is extremely damaging to traders because they never get beyond these simple superstitions. In effect, they never grow up, and they never actually engage the market on an adult basis and treat it like a business, as opposed to some complex exercise in reading tarot cards. So what is a trading system? Interestingly enough, this is actually quite a simple question to answer, because trading systems are at their heart very, very simple. They are a business plan. They cover everything that you do. Every aspect of your trading endeavour is covered by your system. It is not a collection of indicators, interestingly enough. Many people think it is. When I ask people to show me their trading system, they show me a chart plastered with various indicators. That's not a trading system, and we'll see why in a second. This is your archetypal trading system as generated by your average unsophisticated investor. So we have the process of taking the trade at the centre. Psychology gets a little mention, but it's not very important. Position sizing gets a slightly larger mention, but it's still not very important. Exit, well, everybody's heard that exits are important, so they give some lip service to that. And the rest of their time is spent on trying to define the perfect entry. Now, this is how an amateur assembles their trading system. Professional does it slightly differently. At the centre is still the notion of the trade. Entry is relegated to of minor importance. Exit, slightly larger importance because it's a functional aspect of the trade. Position sizing has grown dramatically in importance. This is how much, how many, and is extremely important in deciding what markets you can and can't trade. And interestingly, psychology is the largest of the lot. It is the overall guider of all trading systems. If your head is not screwed on correctly, then it will be impossible for you to trade in any manner using any form of system. And whilst this sometimes gets lip service by traders, they truly don't understand its importance. In terms of concepts within a trading system, and these are the concepts that guide our decision-making process when we're building systems within the mentor program. They need to be simple. They need to be very, very, very simple. They need to be robust so that you can use them over and over and over again. They're not fragile. They're not requiring of inordinately special conditions. They are reproducible, so year in, year out, you get the same returns. It generates the same sort of trades. It doesn't leap around. It is objective. In no way does it require the operator to come up with any form of subjective judgment about what might happen. The system simply says, based upon past information, here is what has happened, here is a signal. The signal is a bet, and that's all. And above all, survival is the key. This is why money management is such an important part of trading systems. There is one rule within exchanges that does apply to you, and that is, if you have no money, you can't play. If all your money is gone, that's it. There is no grant to enable you to buy shares using the exchange's money. You must have your own money. So in closing, I want to leave you with a quote, and this quote is what a trading system is not. And by and large, it is the most effective critique I've come across of most trading systems and most advisory networks.